we are just slightly firmer on the overall market. Of course, it is interest rate decision day, the RBA meeting as we speak. They'll hand down that decision at 2:30 Eastern. We are recouping some of yesterday's losses, so we're up by 0.2%, a similar gain on the S&P ASX 200. Well, there could be a lot more to philanthropy than just writing a cheque, if anybody still writes cheques. Angus Mann from William Buck joining me to look at the strategy behind giving. So what are we seeing in terms of how advisors are looking at a lot of these philanthropic deals given these regulatory changes?
Yes, so there have been some pretty big changes. Finally, Treasury and the government have changed the name of private foundations from ancillary funds, which nobody sort of understood, to giving funds. And they've changed the rules around them as well. So now the minimum level they've got to give away every year is 6%. So anyone with a private foundation, their private giving fund, you can put the money in up front, and people often do that when they have a liquidity event and a big tax bill, get a nice deduction then, give the money away over time. So 6%, the same for public funds, which is better than was originally proposed, which was 8%. And I think there was a bit of worry at the time that that would force people to try and take on a bit too much risk.
So what do people need to know, and how is it going to change philanthropic investing?
Yes, so in terms of the change, I think that some people will sort of look at it and go, we used to be able to give away 4 or 5%, or have to give away 4 or 5% a year, now it's 6%. They'll probably try and dial up sort of, the risk a little bit, which can be of concern. Ultimately, when you put money into a foundation, it's not really yours anymore. You can't take it back. You've gotten your tax deduction. It's really the community's money. And the main thing I think we want to make sure people are doing, we're reinforcing with clients, is that you still need to sort of, remain appropriately invested if that's conservative. But really, it's reminding everyone the need to have a proper investment strategy. And I think this is what we've been through lately with markets, such high levels of volatility, particularly off AI, semiconductors, the Middle East situation and inflation, is the need to have a really good investment strategy that's your roadmap. And I'd argue that anyone, whether it's a single person starting to invest in their 20s through to a big foundation, needs one of those and can sort of, be your fallback in these situations. There's a lot of volatility. People are wondering what to do. You fall back on that. Remind you should be invested for the long term. You should be diversified, and you'll get through periods like this if you've done it properly up front. And
you talk there about volatility. Does that actually impact people that are giving, or does charity or charitable giving sort of remain resilient throughout cycles?
A lot of it is resilient. What we find is that the families with bigger balance sheets can sort of draw back, especially if they're drawing a lot of their income, once they get to second, third generation from their investments. It pulls back a bit. The biggest change we actually see is that a lot of families who often want ESG, a responsible investment in their portfolios, they really sort of put that on hold through these periods. When up until COVID, there was a big uptake in interest in sustainable investing. COVID came, everyone almost abandoned that overnight, and then it's come back since. The same thing happens through periods like this as well.
So, do you see clients then get nervous? Do they pull out of cash? Do they wait on the sidelines, or what are you sort of seeing?
Yes, so on the charitable side, so the other side of the equation, where often they've built up a bit of a balance sheet and they get help investing it, they become far more conservative. The ones who'd started the process of maybe investing it once they get to a threshold of a few $1 million, they just decide to stay in cash for a bit longer and not pull the trigger. I think as advisors, one of the main parts of our role is often getting people to stay committed through these periods. We particularly saw it, say, after Trump's tariff tantrum last year, markets pulled back. You get a lot of phone calls from people worried, wanting to pull it out. In fact, I think last year, a lot of advisors did the right thing. That was the time we took advantage of cheaper prices and put more in. But we see this with every cycle, and it can be a natural reaction. Things have gone down, people worry it's more dangerous, they want to pull it out. It's typically the time that you really need to stay committed and sort of, be brave through that, knowing that markets do go in cycles, and unless we think that something structurally has changed, like it did for a bit during the GFC, you need to sort of stick to the plan through this. And a lot of our time is just sort of talking people, backing it off the window ledge, reminding them that there's a reason and a strategy why we've done this. And if you abandon it, then you're going to miss your goals in some way. Cash will not cover everything that you need. And typically, by the time people realise it's turning and get back in, they'll have missed that uptick again.
What about in this potentially higher for longer interest rate period? How are funds sort of positioning?
Yes, so fixed incomes really sort of come off a lot, particularly when we're seeing that you can often get a better return, a better yield from money sitting in the bank. But if we're expecting interest rates to go higher, then bonds, your longer duration bonds, they're going to get hurt. And we've also sort of seen, particularly over 2022, 2023, the bonds don't necessarily give you that negative correlation to equities that everyone assumes. So really, there's a bit of a pullback from there. Some people are worried about equities, but the numbers sort of support that it's a time that you should actually sort of still maintain a lot of your exposure. What we need to do is not get caught up in the fads. We've seen the South Korean Kospi sort of off a third from its highs, 40%. We've seen semiconductors come off a lot. It's a reminder that the largest volatility isn't in the market as a whole, it's often in little sectors, and people shouldn't be sort of concentrating too much trying to pick the next thing.
It's also a reminder that many of us are very fortunate given all the uncertainty in the world. So is this sort of potentially a time to look at setting up one of these funds?
Absolutely. I think there's always a good time to do it. But thankfully, this has sort of gotten a bit more news coverage than often philanthropy does do. We've seen in Australia over the years that whilst the amount that's given increases, the number of people, a proportion of the population it gives, that's actually been shrinking. So that's part of what the government and Treasury do want to address. And I think it's actually an ideal time whilst the consciousness is there and everyone's thinking about their structures and tax because of the budget. It's a great time to actually be looking at how you can get an advantage yourself, but really help other people. And if you don't have enough money for a foundation, well, there are a lot of other ways you can do it. There are public foundations. There's a great non-for-profit, Australian Philanthropic Services, that runs one of those that helps people, and you don't have to worry that your fees are going into anyone else's pocket. But also, look, think smaller. Try and set up a workplace giving plan if you work in a big company, so everyone gives a bit from pre-tax every month. You don't have to think about it, and really importantly, you don't have to worry about finding your receipts for your donations come the end of the tax year either.
Yeah, absolutely. While I've got you, I just want to ask you a quick question on superannuation as well, given that we now have to really ensure that our beneficiaries are clearly announced, right? Can you talk us through that?
Yes, so it surprises how often people sort of don't understand that when you pass away, your superannuation balance isn't given away as part of your estate. Your will doesn't affect where it goes. And everyone should have a binding death nomination in place in their super fund. It's a good idea. We kind of make sure we review them yearly for clients anyway, even where we've helped them implement it. But if you don't have that in place, the trustees don't need to give the money where you think. Your will doesn't come into it, and you also need to be conscious around the potential tax implications. If money goes to a non-dependent, so not your spouse or a child under 18, or a child who's dependent, then it can actually be tax paid on the way out. So it's really important to get those binding death nominations in place for everyone. Doesn't matter if you're sort of 18 and on your first job, or if you're sort of a retiree with a larger balance. That's really key part of your estate planning, and I think it's one that often a lot of lawyers forget to remind people when they put a will into place as well.
Yeah, and kind of quite alarming for many people finding out that the will doesn't actually cover that.
Yeah, it covers almost everything except for super and some jointly held assets as well.